So as you know, today the board decided to cut the cash rate by 25 basis points to 3.6%. Monetary policy has been working as intended, and we've made good progress on bringing inflation down over the past 18 months. The board's now cut the cash rate by 75 basis points since February this year, as we've become increasingly confident that inflation is on track to be in our 2 to 3% target range on a sustainable basis. Because the price level has gone up so much during the period of high inflation from 2022 to 2024, households are still feeling the pain of those higher costs. And this is why we're so determined to keep inflation down.
We're looking at 2% growth. That's the slow lane for the Aussie inheritance. You know, we're not used to muddling along in that fashion. We may end up with quite weak consumption growth off the back of quite weak income growth. You think that there's a danger that, you know, productivity is hard to conceptualise, that people will think that the bank is just keeping rates too high?
Well, I don't know, Tom. I think the way that we'll be judged is whether we've got inflation coming down and employment is being maintained. And if we can do that, I don't think there's any evidence we're keeping interest rates too high. I want to come back. I mean, I've got so many questions about productivity. The news here isn't productivity. The news here is that this is our third decrease in interest rates. We've had 75 basis points now, and that our inflation is gradually returning sustainably to the target, and that the unemployment rate is remaining pretty low in an historical sense. That is the good news here. And so far that doesn't suggest we've had interest rates too high. It suggests that we've managed you might remember we were in this room maybe a year ago being criticised for not taking interest rates high enough. So I think that's the news that we should be focusing on, and that's the evidence we'll be focusing on to see whether or not interest rates are too high.